Welcome to Section 4, the most quantitative section of the price action course. And don't be afraid if you're allergic to numbers or math or anything. We're going to make this an intuitive takeaway. And we're going to kick it off with talking about the random walk. So the random walk is something that the quant finance community has used to model asset prices. You can think about it as someone that's drunk stumbling on the street from one point to the other with no rhyme or reason. They're just sort of on this path where their prior actions have nothing to do with what they're doing going forward. And this prior movement having no consequence on future movement is called zero sequential correlation. So quants think that the market's solely comprised of pure noise with a long-term baseline drift. So they're modeling this with something called a stochastic differential equation. And here is the equation right here. We're going to go through it and talk about it a little bit, but it's not extremely key for a trader to understand because as far as a day-to-day thing, this higher level math is not needed. So if you're looking for trends or you're a global macro trader looking for ideas to ride, you don't necessarily need to know about this equation at all. It's just useful to get an understanding of how quants model the market because there is a lot of randomness and there is a lot of noise that we have to deal with. So this first term on this equation is the growth rate. So this stands for the growth, and what they do is to get the change in the stock price, they take the average growth rate and then they add it to basically a volatility term. And this volatility term, here's the standard deviation. And it takes standard deviation and times it by a random variable, this dx, which is called a Wiener process. So what that Wiener process is a random variable that's distributed normally. And that's how we get this whole normal distribution concept, is because this Wiener process basically picks a number out of a hat. So it could be 3, maybe it's 2, maybe it's 0.5, and times it by the standard deviation of the stock price. So if 3 comes out, then obviously that's a 3 standard deviation move and we get a larger change. If 0.5 comes out, then that's a smaller standard deviation move and we get a smaller change in the price. So we're going to see a lot more smaller values come out of this dx than larger values because it's distributed normally. And that, for the most case, is true. But when we really look at the data, we see that the model underestimates the amount of large numbers coming out of this dx. And we're going to show you guys that here in a few seconds with some pictures. So here's the Gaussian curve. This is what it looks like, and it says 99.7% of the data are within 3 standard deviations of the mean. So that's why we don't see 4s, 5s, 6s coming out of that dx Wiener process term, is because they're supposed to be extremely rare. But when we look at the market, we find that this is not the case. So outlier moves are far more common than what this normal distribution would suggest. So this is how we get the fat tail concept. So the model would look at markets and try to classify it like this, where in reality, we have these long fat tails, and then also we tend to have more occurrences in the center of the distribution than what the normal distribution would imply. So we see more occurrences up here, and then we see a fatter tail with many more extreme occurrences happening than what the normal distribution would say is happening. So I got a couple of graphs here from Excel so we can see this in a picture form and get an easier takeaway from it. So the black line here is representative of what the weekly returns should be for SPY if they were distributed normally. But we see that's not the case. So whenever this blue stuff is the empirical data, so whenever it pops above the curve, it's happening more than what the normal distribution would expect, and anything below, it's happening less. So we can see, small movements, small returns are happening a lot more than what the model would predict. And then also that fat tail concept where large returns are happening much more often than what the model would predict. And we see the same type of thing in Netflix. So here's the same equations ran on Netflix stock, and we see many more occurrences happening with the small weekly returns, and then the fat tails both on the upside. We see occurrences popping up well above the normal distribution and on the downside. And so we can run this through many other different asset classes. Gold, similar thing. We have the occurrences of small returns happening much more often than what the normal distribution would imply. And then we also see some fat tail occurrences out here. And then finally, Apple, which has that same sort of look and feel to it. Now, more occurrences out here. Now, on the upside, we don't really have a fat tail. We haven't seen one in this particular look back period. But you can see on the downside that, there's some occurrences here that are pretty large that the normal distribution model would never predict. So the key takeaway from this part is to know that markets do have a lot of noise in them, and that stochastic differential equation does model them fairly accurately, but it fails to capture the amount of large moves and also fails to capture the amount of the small moves that we typically have in the market. So now we're going to look at random walk from a different perspective, and we're going to use the binomial model, which is a lot more intuitive, and it's going to help us better understand market movements. So what the binomial model is modeling assets by each node. So basically we reach a node, which is a price, and then we move one time step. And this particular binomial model has a 50% chance of going up and a 50% chance of going down. So this would be a great example of a completely random movement. So each time step, it's up or down. There's no bias baked into the tree. And we can see with this that when we have this, just the noisy 50% chance of going up, 50% chance of going down, no edge type of tree, that trends are harder to reach. So these numbers are probabilities that price eventually reaches this node. And you can see price returning back to a similar area in which it started has a much larger percent chance than trending in one particular direction. And that makes sense because for price to get from here to here, at each node we have to quote unquote roll a black on the roulette table. So let's say black's up and red's down. In order to get to this higher point, we'd have to have a black and then a black and then a black and then another black, 4 in a row here. When this 37.5, there's many different paths. We can go red, and then maybe we roll a black, and then a red, and then a black. We can also go black, black, red, red. So there's many more combinations that get us to the center here. And that's consistent with the fact that markets are consolidating much more than they are trending, because it's statistically harder for an asset to continue going in the same direction. Now, it can occur, and it does occur more often than what the perfect random walk model would predict. But in general, this is a good mental model to have, that a price moving far away from where it's currently at is much more statistically unlikely to occur than if it were to just move from where it is now to a small place away from where it started. So without an edge, price is equally likely to go up as it is down. And so our takeaway here is, if we just enter the market, the expected outcomes actually break even. When we're at that node, we have a 50% chance of going up or down if we have no edge. So what we really want to do in reality is entering an asset that has a skewed probability. So maybe it has 60% chance of going up and 40% chance of going down. But the equilibrium state that we're starting at is 50-50. So it's not necessarily a losing trade. Any trade, the expected outcome that we make is actually break even if we don't have an edge. So we can embrace the randomness of the market and embrace a lot of the noise, because take, for the example, 10 random trades, with small bet sizes and with all stops behind them. The outcome isn't necessarily negative because most of the market action is random. So we'll probably win a few, we'll probably lose a few, and we'll most likely break even. So what the trick in markets is not just winning, because anyone can buy a stock and half the time will go up, half the time will go down, and create some winning trades, but it's consistently winning. It's consistently applying an edge. So if we can consistently win and consistently outpredict that binomial tree, then that implies that we do have an edge in the markets and we can make profitable trades. So break even is our real enemy. And that's because if we are breaking even our trades, then we're doing stuff, we're applying methods to the market that are trading off of false patterns or false logic, because we think we see something in the market, and so we're taking trades, but really we're just seeing noise. And this is the worst case scenario for the speculator, because we can spin our wheels for years and years wondering why our analysis is not working correctly. And it's actually worse than, say, consistently losing, because if we're consistently losing, then we're finding a consistent pattern in the market. Now, it's not necessarily a profitable one, but if you can take the other side, maybe you can make it into one. So break even is a sign that you're falling prey to the randomness of the market, and you need to try to find an area where you can create consistency and not just have a 50% chance of going up or down every trade you take. So when we're trading the markets, there's usually 3 scenarios that come up. It's scenario 1, which the method has an edge in profits. That's the one we're looking for. Scenario 2, which is actually the most probable scenario, is that we're just simply trading the noise, and we're on that 50-50 binomial tree, where the outcomes at each step are just 50% up or down. And then scenario 3, the method is a negative edge and loses. So we're actually doing something that consistently loses, which is interesting in its own right, because that means we did find a pattern that is consistent in the markets. We're just taking the wrong side when that thing occurs. So like something that comes to mind on scenario 3 would be maybe shorting S&P 500 when it has had a huge dip. That's typically a very bad entry to make, and that would show consistent losses. So if instead we said, hey, instead of shorting a dip in S&P, we bought a dip, we can turn scenario 3 into scenario 1. Scenario 2 is the treadmill scenario, where you really don't know what's happening, and you could just be seeing noise and mistaking what your patterns or your indicators or your process for something that has edge, when in fact it's just white noise. So try this. It's an interesting experiment. You can do it on paper trading to see this break-even nature of the market. Is try to lose on purpose. To try to take trades that you see on the chart or by your analysis that are losing trades, and you're going to see that a lot of these trades are actually going to win. So it's very hard to lose on a consistent basis. It's just as hard to lose on a consistent basis as it is to win on a consistent basis. And that's because most of the market is noise. So if you think you have a losing signal and you take it, a lot of times it's actually going to win. So this will help you internalize how random the market can actually be in between those pockets of clarity. So the only caveat to this exercise, if you're going to do it, is to make sure that you have small bet sizes and you have a defined risk strategy, because obviously if you have too much leverage, that's going to kill any type of strategy. So let's take the extreme scenario of where we're betting our 100% of our account on each trade. Well, that is destined to blow out even with the best edge, because the best edges are still not going to have 100% win rates. So when you do this strategy of testing maybe what you think is a losing signal, use stops, use small amount of size, and you'll be able to see how, there is a lot more noise in the market than maybe what I thought. And this is very useful to us because it humbles us and makes us internalize the fact that we really need to stick with the pockets of clarity in the market. We're in a sea of noise and a sea of randomness. And those models that I showed you in the beginning of the lecture from the quant community are right many times. But there's those small little areas, those outlier areas that we're really focusing on hitting and exploiting.